Right, Australian house prices. House prices topical, right? IMF, they look at Australia every other day and say, you guys are lunatics with your house prices. Obviously, Evergrande, house pricing bubble, $400 billion in debt, exploding. GFC was all about house prices, right, and leverage. There's way more money invested in Australian real estate than the equity market. I know that's the case globally. So the big question is where are house prices today in terms of genuine affordability, right? Because that's what drives it, not perceived affordability, but genuine affordability. But for me as a trader, it's more importantly because I'm interest rate sensitive, right? Where can and will the RBA raise rates to without blowing the windows out of every other Australian household and causing a massive disaster, right? I'm short the Aussie bonds, like the 10-year bonds. I've been short them just down here, right? And this is the chart of the Aussie 10-year yield going back like 40 years, right? And you can see it's just in one direction. Anyone thinks the RBA, the central banks, raise and cut rates, they're delusional, right? You look at this, they just cut rates. That's all they do. They're the Ministry of Housing for Australia. They think that they're supporting wages and all this kind of stuff, but really it's all about the impact of interest rates on household debt and the wealth effect, and that is all they do, right? That's it. If anyone thinks they do something else broader for the economy, I reckon they're delusional. It is all about housing prices and the wealth. That's what they control. It's really delusional. Like, this is what makes or breaks the economy. So the big question is, where to next for the RBA? And in particular, are they going to break some of these levels, right? Let's go to my little spreadsheet that I've put together. This is an interesting little cookie, right? This is the Australian housing market in terms of the wages, the interest rates, and the prices, right? Because, and this is where I got the data from. This is the February cash rate from the RBA going back 30 years, right? This is the average weekly earnings from the Australian Bureau of Statistics going back 30 years. There's a little bit of interpolation in here, right? Because they archive some of their data in here. So they're not totally exact, but that's their wage price index. So it's a pretty good proxy working from there. But you can see, the growth is pretty standard. 27, 30, 31, 32, 33, 37, 38, 40, 42, 43, 44, up to 90, where we are today, right? So that's the source for that data, that's the source for that data, that's the source for this data. Sorry, this annual income is just that by 52. There's a few different wage series from the ABS, but you can look it up for yourself, but this one is consistent. This is the Sydney median house price. It's actually pretty hard, I found, to find the national median house price going back consistently. So this is for Sydney, and from a few different sources, right? The ABS or RBA has, like an index of these things, but I haven't been able to find the actual median house prices, right? Now, Sydney's more expensive than the rest of the country, so there is that factor, and obviously the wages in Sydney are higher, but like for like, it's a reasonable comparison, it's consistent. So when you look at the house prices, right, and the incomes, you see a few things. Now, the first thing we're going to look at is over here, which is the house price to income ratio, right, which is what people are really having babies over, and they say, my God, look at this. House price affordability, it's at all-time highs. When I had my first mortgage, right, it's like in 1995, right, I was able to borrow like 3 times, maybe 2.5 times my salary, right? The median in Sydney for a house, or I was buying, a unit, right? It's a different story, right? Now, look at this, it's 3 times higher. And people go, this is ridiculous. House prices are out of control. I go, yeah, look, on that measure they are, but who in their right mind these days, or any time, pays cash for houses? They don't, they borrow it, right? So the people who look at the house price income ratio without thinking about actually the fact they borrow money is frankly like, they've got no credibility. They just don't have a leg to stand on, right? So you've got to take into account the interest rates. Now, when you look at interest rates, it's a remarkably different story, right? When you look at, so based on like an 80% mortgage, which is standard, a lending rate of the cash rate plus 2%, which is pretty standard over these things. I remember like when I had my first mortgage, it was like 9.5%. I remember it coming down thinking this is fantastic, right? These days it's like 2.5%. Okay. So over that, when you look at the repayments, right, based on your cash rate plus 2%, based on 80% of your median house price, right, this is how much you pay. And back then it was like 36%, or when I took out my loan, it was like 40% of your gross wage. Okay. Now you can see back in the days of the recession that Australia had, it was outrageous. No wonder it caused the recession we had to have, because look at the damage it did up there. And since then, like it has got back to 60, like back in here, like leading into the GFC, when the RBA was trying to slow things down, and it kind of hit the 50% and started to top out, and it turned, right? And that was the hiking cycle in there. You can see 7% was the high there. Well, where it is now, right? It's down, it's actually under 30%. It has at no time been lower in the last 30 years, right? So when people say house prices are through the roof, you go, well, actually, they're not. When you look at the affordability, they're cheaper than ever, and the problem is that cash is worthless, right? When I was back here, when I first started working, which was in 1989, right, just before here, I was putting money in a cash management trust. I was getting, like around here, 16, 17% per year, right? So on $1 million, that's $160,000. Here, you've got $1 million in the bank, right? You get $1,000 for it. Cash is worthless, right? That's the problem that we've got. That's the problem that the RBA has created. They've made cash like worthless. So for all these people sitting on these great house price gains, well, good on you, right? But it's because your cash is worthless, and when you go to cash it in, when you're old and grey and you want to sell your house and you want to retire, and you want to put it in your bank, a lot of conservative investors, they're 75 years old, and it's got to go in cash. You're not going to be getting, like, back here 10 years ago, call it like, 4 or 5%, you're not going to get like your 40, 50 grand a year. You're going to get $1,000 a year. You've taken like a 98% pay cut because of what the RBA has done. So good job in the RBA. Like, as you can tell, like I'm pretty cynical about these guys. But when it comes to affordability, there is an issue, right? Because just as you get the benefit of low interest rates as when you've got a mortgage, right? When you've got to pay your deposit, it works against you, because your deposit you have to pay in cash, right? So when you look at your deposit that you had to have to your income, back here you can see how it's grown consistently over time. So now the deposit, like a 20% deposit compared to your annual income, it's coming up to 3 times that, whereas it used to be like 1 for 1, so that's brutal. And in terms of Australia, that's what the real problem in the housing market, because it means if you're a first home buyer and you've got to save the cash for your deposit, it takes you a lot longer. Whereas if you're an investor and you can roll over your equity in your existing property, you don't actually have to pay cash for a deposit, and you can just roll it on. So this is where affordability is an issue, and where, when you're thinking about house prices aren't insane, right? The affordability, aren't insane because of this. The affordability for first home buyers, not subsequent buyers, for first home buyers, it's a real problem. Everyone else, you're laughing, right? So that's where we are now. So that's where we're housing. So really, on this measure, we're kind of pretty cheap. And I kind of think, well, where can the RBA raise rates to get it back into this like band of slowing things down, right? And it's, if they added another like 200 points, 225 points, that takes it. That increases where the house prices are today, that 52% level there. that takes it back here. So I think that the RBA, as it stands today, could easily add 2% to raise things more, right? Could they take it like further, 3.5%? You're going to be choking up here and up here. That's the only time it's been up here, right? So 3%. Could they do 3%? That'd be pretty hefty. That kind of takes it into this band, right? I think maybe 2.75%. That'd be 2.5 over where they are now. So basically 2 to 2.5, I think, is where they can go. The flip side of that is, well, where could house prices go where it starts creating an issue, right? They could really double, right, at the current levels, right? So the RBA's got to do something, because if they don't, people are going to keep bidding up these prices to an insane level. So for me, going from where we are today, where your 26% of your income goes on 80% of a mortgage based on a Australian weekly average weekly income of annual wage of that, Sydney median house price, it's 250 points, and I think that's the upper limit. So in terms of Australian house prices being outrageous, look, they're actually not, right? But if you've got one, it's not. If you're trying to get your first one, they are really outrageous, right? And that's why it's a regulatory problem solving housing affordability, not an RBA one. The regulators have got to come in and do something to help the first home buyers and the deposit, because it's skewed for secondary investors. So that's the housing market. Now, what does that mean for bonds for me as a trader? We can look at a few things here. Like the way in which these bonds trade, they hit a level, they come back, jump around, they kind of find a new low, right? They come back up, and then they find a new low down here, right? So, that new low, it came back and hit it there. It's like a ratchet kind of spanner, right? Because of the whole affordability. So they keep re-normalising where rates can and should be. This is where we are at the moment, like 137 with a ratchet level of 180. Let's have a look where 200 to 250 points is from this level. 250 points, right? Well, that's 200. That's basically 200, right? There, 290, right? So it takes us into this band here, which looks a little bit scary, but it would certainly normalise them substantially back into this range. This is again the 10-year bond I'm talking about, so this is not the cash rate, right? So it might be, obviously they're not one-to-one correlated at all, right? But there will be a correlation in terms of the steepener as the cash starts to rise, and it will influence the 10-year. So to me, I think that looks like a pretty good gap to fill. And as I said, from where we are today, that is within that 2.5 range, bang on 2 to 2.5. So that's what I'm looking at for my trading, and that's the rundown on house price affordability. Spot check some of these if you can and help me out, because as I said, it was remarkably difficult to track down some of this data. Being an Australian, it is my civic duty to educate, to discuss house prices and hopefully educate them. But really, when you look at the RBA, they are the Ministry of House Pricing, right? They are the biggest drug dealer in the country. They feed people drugs in terms of lower rates to get themselves drugged up on housing. And now that there is a drug problem, they're saying, well, you guys better be careful. And you go, well, you guys are the actual drug dealers, right? You are the guys that are causing this. If you want to call it a bubble, you can call it a bubble. On some levels it is, on others it really isn't. It's a problem for the first home buyers How can they solve it? Look, really, when they talk about wages growth, right, is what's going to solve this. Right? The slowing down the economy is what they can do, right? So the RBA, they're kind of a bit stymied in terms of they want wages to grow, right, to help this affordability, right? But as the wages grow, right, it's going to make the investors wind up even more, right? Because you kind of think, right, okay, what if wages grow by, by 15%, right? That helps like a little bit, but it really, helps these guys just as much. Right? So wages growth is part of the problem. So they're in a bit of a dilemma. They've fed the country like this free money. They've made money so worthless, and they've got a real problem for how to solve it. I'm not sure what they're going to do. They're kind of zooanged in terms of the chess moves. But to me, I think when people talk about a 2 to 2.5% raise in cash rate, that is very doable without blowing down the windows. More than that, it starts to get a problem. As you can see, like if they raise it by like 3.25, it gets back to some really painful highs. That's not going to happen, I hope. Anyway, that's it. I hope there's been a little bit of an education on the Australian housing market, and in particular where we are going with the bonds. That's the last thing I want to look at is in terms of the ratcheting. This is the position that I've had on, being short the bonds along the yields, and today it has come, it's been quite a move. This is really a long-term hedge for me, which is why I'm not getting out of this position. I've got a long leveraged high yield portfolio, right? So if interest rates go up, that kind of kills the carry. So I'm short this to help it. There goes my phone. That'll be a call level on my futures. The futures are sinking as we speak. The Aussie futures, they must have hit 7,200 or something. So it's come back to this 140 level. Fibbo, standard, right, whatever. Top of the trend, yep, to be expected. And of course, the way this market trades, the ratcheting, it's kind of come back to there. I think it's going to could well pull back. I still got my eye on it, then breaking this. This is that long-term monthly line that goes back forever and a day. All right, I hope that's been enjoyable. Have a good one. I better go and check my core level in the Aussie market. Okay, ciao.